Hey everyone, thanks so much for joining us. This is actually a pretty significant moment for us, anyways, and so we appreciate everyone who is watching this. We're just gonna try, the webinars can tend to be a little dry at times, but we're gonna do our best to get you through this. We're gonna provide a little bit of education. We're gonna talk about what we're all about and just give you a chance to get to know us and what we're actually trying to do. My name is Dr. Peter Kim. I've got, Dr. Pranay Parikh. We've got Dr. Myth, Jacob Ragasin, and honestly, it's just a great, really, just a great group of people here, just who want to get to know you. And we want to talk about Ascent Equity Group. This is new for a lot of people. Some people have already actually invested through Ascent, but this might be totally new to some of you. I mean, you might have seen us in different areas, but this is the first time we've actually come together as a group to really provide a vehicle for physicians or other high income professionals to really, in our opinion, do well in real estate. So we're called Ascent Equity Group, and we're going to be announcing the Fund One, and that's what we're going to be talking about today. On our next page, there's a little bit of a disclaimer. If you do, we'll be sending this slideshow out. We want to make sure that we do right by everybody and provide the proper disclosures. The things we're going to be talking about today is accurate as best as we can make it. Just so you know, there is no sort of guarantee of results in any case scenario, but we can lay out the data and the information as best as we can. As we continue to go throughout this, if I mention the fund, I'm going to be talking about Ascent Equity Group Fund One, and that's what we're talking about, the multifamily fund one. And then whenever we talk about the group as well, or investment, or the managers, I'm going to be referring to Ascent Equity Group LLC. As I've been along, a lot of people know my story and personally, where I'm an anesthesiologist. For those who don't know, the goal of investing in real estate for me really was to provide financial security and financial freedom. I wanted another source of income outside of medicine to be able to, give me the ultimate like financial security for my family, really give me a hedge against the unknown. And especially in a time like today, ultimately it has provided that. And I'm so glad I have it. And I think there's the same reasons why Myth and Pranay have invested in real estate as well. The one thing that has been a challenge I found through all this is knowing where to put that money and that investment and that capital. Because I don't know about you, but I had a couple goals. Number one, I wanted that income, I wanted that cash flow, but I also wanted to minimize my risk, and I wanted to get a lot of what's called diversification. And if you know anything about me, I'm a nut about diversification because I feel like if you are fully diversified across, multiple what's called sponsors or operators, so people running the deal across geography in different places, different markets, and even in diversification across different types of investments in real estate, I feel like that allows for a lot of risk to be mitigated. Now, how are you able to do that while also trying to have a good upside as well? And that's been the challenge. And I think that we've been talking about it amongst ourselves as a group. I don't know about you, but I spent so much time, these guys as well, over the last 4 to 5 years, just getting to know different people in the space who are running these types of deals. And we found so many quality operators and sponsors out there, but unfortunately, a lot of them wouldn't cater or wouldn't actually work with the individual physician like myself. And so we found that the only way to do so is to kind of leverage the group, get other physicians together, bring in that power and that capital, and then honestly, we can get a seat at the table. And so our goal from a while ago was to figure out how to make this happen for people that invest, like in our investor club, people that we talked about investing, how to create that. And finally, we were able to do that. It's taken a while to get this together, but again, we're so proud to really announce Ascent Equity Group Fund One. We have these connections. We have different sponsors. We have different people, and we're going to be taking this fund and this capital, and we're able to provide access for other physicians, high income professionals into these type of investments. We're going to talk a little bit about that today. And that's through this fund model that we're talking about. And the goal is that with one investment, people are able to have access to all of this at the same time. Because again, that's been a challenge, especially with some of these investments that have a little bit of higher minimums. Like, what do you do? Do you split it across, other operators, less known operators with lower minimums? Do you go all in on one? And I think that's been the challenge. And that's what we've been hearing from so many people. And so we try to solve that problem with that fund today. And so just wanted to share what the details are of this fund. Just so you know, our focus is on multifamily. So meaning for the most part, it's It's apartment buildings. It's something that we know quite well, something that we've invested in for a while. Many of you understand it conceptually. People need places to live. Those are apartment buildings. And over time, it's shown to be extremely, extremely strong in terms of cash flow as well as returns. And so we feel comfortable investing in that area. And that's our main focus. Now, within multifamily, there are different types of investments, whether it's something called development, where the people actually build those apartment buildings, whether they do something called value add, where they take those apartment buildings and add value by either renovating, improving the property and increasing rents and increasing that value over time. Or there's properties that maybe need a little bit of a tune up to do a little bit better. And those are more like the core over here, the core and the core plus properties. And so we're focusing across all of those because, again, the goal is diversification across not only geography, sponsors, but also the type of deal itself. We'll be focusing on multifamily apartments. The group is called Ascent Equity Group. And the goal of this fund is we're trying to raise somewhere between $10 and $15 million to go take that sizable check and do all those things that we've talked about, find a seat at the table with these sponsors that normally wouldn't talk to like a single investor like myself, and honestly try to get better terms if we can, and make sure that we're intimately involved in ultimately a lot of decisions that actually happen with the fund as well. So our goals with this fund is to try to find anywhere from 3 to 7 deals within this one fund itself. So when you make that one investment, or whoever might make that one investment, they have access to multiple deals at the same time. And because of that, because of the different hold periods of those investments, the fund is going to be somewhere between, we expect the hold to be between 5 and 7 years. It kind of depends on when the properties that are in the fund kind of go through that whole cycle where they get built up and then they get ultimately sold off at the end of the day. And our goal is to diversify geographically. So, I'm on the coast, on the West Coast, but we like the Midwest, we like the Southeast. Market conditions are changing all over, as you know, even post-COVID or during COVID, sorry. And so it's important, I think, to make sure we have that good geographical diversification as we think about this fund. So moving on to the next slide, people have always asked, there's something called a waterfall. And many of the people that are watching this have been part of the Passive Income MD Passive Real Estate Academy. So this is probably all very well known to you. But for some of you who may not understand what this means, I'm going to explain it really quickly. Just a waterfall is the way that distributions are given out to investors as well as the manager. There is a set order in which this happens. And so as one bucket is filled, it moves to the next one and the next one. In this case, we've tried to make this fund as investor friendly as possible. This is our first fund. We want this to do obviously extremely well for investors. And so we came up with terms that we think is best in class, meaning that you will not find these terms anywhere else. And so what it is it's 10% preferred return in the very front. And what that means is that until you get your 10%, an investor gets their 10%, then none of the other buckets are filled. So nobody else participates in any of that until that 10% is at least met. After that, then your equity is returned in full. And only after that is there a split between the investors and the fund managers in terms of splitting those profits. And that's in a ratio of 80 to 20. And again, that is probably the best that, hopefully that you can find anywhere else. We expect this to provide cash flow very early on. And again, that's been the goal of real estate for me, to provide cash flow. And we expect it to be somewhere between 4 to 6% early on in year one, and increasing anywhere from 1 to 3% every year from that point until the end of the fund. And we expect that to start taking place at the end of Q2 2021. So that should be pretty soon. So we are making investments where we know that the cash flow will be coming back to us pretty quickly, and that's been a goal of ours. All the while, we'll be looking at the whole fund in general, and we're expecting and hoping to get and actually really focusing on getting investor returns of about 12 to 14% IRR. And to explain what that is really quickly for some of you, IRR is not a clear, it's not like an annual return, very clean. With these type of funds, distributions come out at uneven times as cash flow goes up, these properties get sold. But if you're to account for the time, like the time factor, like money factor, when it comes to time, and all those returns are smoothed out, it comes out to somewhere between 12 and 14%. And the minimum investment for this fund, because of the fund size that we need to get to and some SEC regulations that actually really define and restrict the number of investors that we can take into this, it's $100,000. And I know that so many of you have already expressed interest in this, so we're really excited to get this moving forward. And to talk a little bit more about some of the details of the fund itself, to talk about where we're going with this, some of our objectives, our due diligence on this, I'm going to turn this over to Dr. Pranay Parikh.
Thank you, Peter. Just one couple quick points I wanted to talk about. A lot of people here have taken our course, but for those that don't know what a real estate fund is, we go in and put in pieces of our fund into other people's real estate. So say Peter is going to go buy a 200 apartment complex by himself and he needs money. And so he will come up to someone with a fund and hey, Pranay, I need $5 million or something. And so then someone else somewhere in like Florida or something will say, hey, I need 2.5 million. So it's a nice way. It's almost like a mutual fund for real estate properties, but you actually own a piece of that property. And then one thing I just wanted to mention about the waterfall is it really is best in class. We actually had a handful of people tell us that that the number was too high, either to go down to 8 pref or go down to 70/30. So we said no, we want to keep it like that. And actually a couple operators, Peter and I just had a lunch with an operator yesterday. He's like, oh, I'm going to invest in your guys' funds because the investor, it's so investor focused. So and Myth is going to talk a little bit about how we do underwriting and what kind of deals we look at. So go ahead, Myth.
Great. So the whole goal for us is to really find the best real estate opportunities. And kind of the way I view it and really look at it is we're not only looking at the markets which we're investing in and looking and concentrating on the best submarkets, but then we also want to have the best sponsors and the best operators, because ultimately those are the people who are going to be able to do the deal, carry it forward. And then we as a group, Peter Pranay and I, really take a deep dive into each deal to make sure we really understand what the assumptions are, stress test it to make it the best deal possible going into it. Okay, so really the linchpin of all this is a sponsor. And this is where we all spend our time. Every day, all three of us, we're talking to different sponsors across the country. And these people are people who predominantly we're actually getting referred to. We're going through our network and they're saying, we've already invested with these guys and girls. They've done great. They really have had solid returns. And so then we get an opportunity through our network to talk with them. And then we just continue building our relationships. And these are really long-term relationships that we've been cultivating so we can get to know them on a personal level. Some of the sponsors we've actually met and had lunch with, this is all pre-COVID, just to make sure. And so we go through their track record with a really fine tooth and comb to understand what they've done in the past and to see what they can potentially do in the future. And then we go through each one of the aspects of their portfolio and see how they were able to achieve their returns and see if that's actually a replicatable model. If they're able to get their returns just because it was a really great market and all the prices were going up, and so they were just able to catch that headwind, or they actually were able to increase the rents and drive down the expenses. And that's what we really want with someone who has a reproducible model. So that's great to see. And so for the underwriting portion of it, what each deal, we'll get it. And we see so many deals throughout the course of a week. I would say at a minimum, we're sent 5 deals, and sometimes it's up to 12 deals a week. And we're really turning all these ones down because for various reasons, it may not be a great fit for us. We may not believe in the market. We may not believe the sponsor is a good fit for that market. And so because of the amount of deal flow that we have, we can be really, really selective. And so when we're underwriting this, I start off and I actually look at the deal from a fresh lens, and I put it through my own models, and I put in my own assumptions in, and then I put in best cases, worst cases, and I stress test it. And I can show you all these things that we kind of go through and get the actual deals populated inside the fund. Then I go back to the sponsor and I actually talk to them about it and say, hey, this is what I'm thinking. Let's compare our models. And it's a lot of back and forth. And so just because of the amount of access we have now, we're able to get questions answered, which other people probably wouldn't be able to. And we really understand what they're doing. And another side benefit is that we can talk to people outside of the sponsorship team who are really familiar with the market and say, hey, what do you think about this now? So we can really triangulate and get multiple perspectives and multiple different ideas. And then ultimately, we've gone ahead and got several different databases which provide industry insider knowledge about what they think rents are going to do. So it's really, we take all the numbers and assumptions that the sponsor gives us that I put in, and we're double checking it with hard data. And that is really, really important. So we have third-party data, which is coming in as well. So based on all these different things, we're able to find great sponsors who are in great markets, and then ultimately who provide us with great deals. And so that's kind of the three-legged stool of what the deals that we're looking for.
Awesome. Let's see. Okay, so I want to talk a little bit about logistics. So for us, transparency is very important. And so we will be working with a third-party administrator. Those of us who have done a deal with us already know that we're using Assure. So kind of the process is that if you decide to invest with us, your money will go to a third-party administrator. We never touch the money going in or coming out. They will accreditate you. They will kind of take care of all that process. They will take care of tax returns, K-1s, and all that stuff. So once you decide, if you decide to invest, you will send your money to them, and they'll send the money to whatever sponsor we're working with. And then the distribution will go to them and then go to you. So it kind of adds some transparency and a third-party resource outside of us. And Assure is in control of billions of dollars and have done hundreds of SPVs already this year and thousands a year normally. And then very quickly, I want to do some frequently asked questions. So I do see the questions in the chat, so we'll definitely go to those. So first question, will this be a blind fund? This is a blind fund. We actually have a couple deals that Myth will talk about in a second that we're interested in putting in the deal, but otherwise it will be a blind fund. It will use kind of the criteria that Myth and Peter talked about earlier. Do we intend to use leverage? So the sponsors that we're investing in, we're trying to find conservative sponsors that will use leverage 65 to 75%. We may make an exception, but that's kind of the numbers that we're looking for. And it will have to be exceptional case for us to consider anything outside of that. This is something that I definitely want people to pay attention to. So we are giving a 10% preferred return, and that will start about, so it'll start at the first investment that we're gonna make, but we will not have all the investments made right away. We have a couple that we have in mind, and we'll probably make that. We might close the fund in a month or two because we have so many deals coming to us. I know someone asked about how soon we're looking to close the fund, but it may take a couple months. So say it takes longer than that, we will start to accrue your preferred return up to 90 days. So it becomes 90 days, say it's not full, we're going to just start the clock. You're going to start getting preferred return and after 90 days or sooner. So keep that in mind. Distributions, so Peter talked about that. The investments, the two investments that we're looking to make, they're going to cash flow very soon. So this is actually pretty rare for funds to start giving cash distributions that quickly. So we're pretty proud of that. So yeah, we'll make distributions after about 60 days of the close of each quarter. We will give you guys reports, K1s, all that good stuff. That's pretty standard. Okay. Yeah, so we kind of talked about this. We'll deploy capital once we find a good deal. You guys know what accredited investors means. No 1031. We'll talk about preferred return. Remember, the waterfall is 10% preferred return, return of capital, and then 80-20. Okay. And then quickly, this is kind of just the general structure. The sponsors will be kind of handling all the work of the turnaround plan, buying, selling the property, and then we will take care of quarterly reports, all the communications and distributions and taxes and all that stuff. You guys know why we like multifamily. Apartments are fairly resistant proof. I'll let you take a look at this, but multifamily has just been doing very well. Myth, can you talk a little bit about the sponsors that we're interested in working with and have worked in the past?
Yeah, definitely. And so just piggyback off the question, some of the questions in the chat here. So just because we have an SEC lawyer and because of the rules that are in place regarding funds, we can tell you generally the kind of deals that we're interested in. And we do have 2 deals that we're looking at very closely and with 2 different sponsors. And so just kind of, a general idea. So one of them is Olympus Properties. And this is actually a group which Pranay has met with personally. And we all know personally, have talked with on several different occasions. And so they were started in 2006, all in value add multifamily. They've kind of gone out into development deals, but that's not what we're focusing in here. So they're in value add multifamily, and their track record is it's really good. Their IRR is 36.8%, and their equity multiple is about 3.3. And they own 11,000 units. So this is really a big time sponsor. They have a fund which they invest in multiple different states. And so they are a very interesting sponsor to us, given their track record, their success, their ability to operate. And the next sponsor, which we're really excited about and potentially looking at a deal with, is Tides. So Tides is a group which was started more recently, but the principals or the founders have been doing multifamily for years and decades. They're based in California, but have done deals in Phoenix and Dallas, and then expanding out into Las Vegas as well. Their track record is also really good, with an IRR of 39%. They hold their deals for a short amount of time, so their equity multiple is 1.8. They're closing in almost $1 billion, so $950 million of real estate purchased. And so they are a really, really big value add multifamily sponsor. They have a deal in Dallas, Fort Worth, which we're really interested in. They've just shown us time and time again through their track record that they're able to operate and turn around properties at a level which few other sponsors can. And we've really spent a lot of time getting to know their deals and understanding how they're able to do what they can do. Their deals fill up so quickly that we're really fortunate to be able to be pursuing a potential deal, which we've got a special carve out. So that's really big for us, because normally as soon as they put a deal out, it gets filled almost instantaneously just because of their track record.
Yeah, so I'm going to go through some questions. Are you guys personally investing? Yes, I plan on personally investing my own money into the deal.
Hey, Pranay, I want to clarify something because
Yeah.
somebody mentioned about closing the fund. I want to make sure we understand what that means when somebody says, when do you expect to close the fund?
Yeah.
You mentioned closing the fund in terms of closing the
so-
investments, but in terms of the actual, you want to talk about the mechanics of the actual investment itself?
Yeah. So there's a couple different kind of timelines for the fund. As you'll see in the paperwork, we have up to kind of 12 months to accept money, but we're already oversubscribed. So we can have a maximum of 100 investors, not including us. So actually only 97, including us 3, into the fund. And we have about, I think 140 last I saw. So we expect when we open it up that it'll fill up pretty quickly. So when I mean closing to new investments, so we think that's going to happen in the near future. And then the next kind of big timeline is when we close the fund to making new investments. So the fund will be making 3 to 7 investments. And like Myth was saying, we already have 2 in mind for 5 million. So that's potentially half the fund already. And we have a couple other deals in the works. So the fund may close to making new investments in the next couple of months. So that'll be pretty quick as well. So as you can see, things are moving fairly quickly because there's a lot of great deals. There's a lot of pent up excitement for investing in multifamily. So yeah. So someone asked about tax advantages, syndication deals. Yeah. So the benefit of syndications that I assume you're talking about is the passing on depreciation. So yeah, so typically the sponsors will pass on their depreciation. It's different for each deal, but a lot of them, but it's pretty similar. Just like in syndications, you can get X amount of depreciation that the sponsor decides in the deal. You'll get the same in a fund. Yeah. Yes, we will have a copy of this.
Again, for those who are on this, thank you so much for participating in this. This is our, we're super excited because this fund we feel is the best way that we can actually serve people that we've been talking to about these investments for a while. I think it's been a challenge for us because so many times people come to us and say, they had the education, they just don't know where to actually take that capital income and invest in. And a lot of times we just didn't have a great answer for them because there's always a plus and minus or a plus and minus for that. But again, in this situation, we feel like this is the best opportunity, at least for us and what we've been able to create, where we can accumulate all our capital together and have the best leverage and put ourselves in the best situation to succeed when it comes to investing in these passive real estate investments. Because oftentimes, as you may know, as a limited partner in some of these investments, you're just a small, pebble in this whole sea, right? But in this situation, I feel like if we can leverage our capital together, we've got a seat at the table where we can ask for, honestly, when we talk to these sponsors, the level of due diligence that we can ask for is far beyond something that I, as like a limited partner, that I can ask for. We're asking for all of their background, all of their numbers, all of this stuff. And, they're providing full transparency for everything. So we have the opportunity to do that. At the same time, we're also able to get access to a lot of these investments that honestly have investments that are out of reach for us. The problem with a lot of these bigger operators, once they get extremely successful, oftentimes, finding investments is not necessarily a problem. So they continue to raise their investments over time. And so that becomes problematic for someone like, maybe someone like me who wants to invest with a certain, somebody that has a track record for 20, 30 years, positive track record without ever loss of capital. Oftentimes, I can't get access to it unless I put in $250,000, for example. So we try to figure out how do we create something where we can do that together collectively as a group and do something that we wish we had when we were investing in these type of things. And so that's how Ascent, this fund was created. Now, somebody had asked, there's some other really good questions. Somebody asked about are we investing into single projects or funds themselves? And I thought that was a great question.
Mm-hmm.
We are going to be we could invest in both. We're targeting single investments because we like to know the exact property and that sort of thing. There's a potential to invest in funds as well, but it's got to be worth it. Just so you know, when we go into these investments with these operators and sponsors, because of the check size that we are able to bring, we're able to oftentimes get better returns, get better splits, get better these kind of things. And that's what we're doing in terms of leveraging the group to be able to do so. And so with the fund model, it has to make sense for us to be able to go into another fund because that does add another layer of fees. So we want to make sure that if we are doing and going into a fund, that it actually will be truly worth it at the end of the day. So I would say it's possible. It kind of depends on investment by investment, case.
Yeah, so in the end, we kind of want to aim for that 12 to 14% IRR and equity multiple that Myth said. So we kind of have that in the back of our mind for every deal. So if it's a fund that makes sense to keep us in there, like the Olympus one, there's for them specifically, there are no fund level fees, which is awesome. So we just keep that in mind. Pritam asked, how would you know if you're admitted into the fund? So we have a platinum investor club for people that are taking our course. So they will have first kind of at bat to get into the fund, and then after that will be the PIMD investor club. So we assume from that it'll fill up. And so those are kind of the two different avenues we'll go. So we have both lists, and we'll send everyone the link.
Yeah, we've asked for a soft commit from people. We did send out an email. I think, well, I'm sure everyone received it if they're on the Zoom call, but we sent out an email for people to put in soft commits. And soft commitments, again, there's no hard commitment. We're not banging down your door. It's just for you to let us know that you're interested in this sort of thing. But we've also, with the soft commit, because you have allowed us, let us know, there is a priority according to that soft commit list as well, too. And so That's why we again, we appreciate those who have spent the time to put your name on there.
What are the exit options for a fund like this, early exit? We really tell people that if you plan on needing or think you may need this money, I know 100,000 is a lot of money in the next 5 to 7 years, that it might not make sense to invest. You should think of this as pretty much 100% in the fund. So that's a good way to look at it. There's some legalese around it, but it's complicated and not fun. So if you plan on needing this money, it would be better not to invest. Let's see. Thank you. So you would be limited partners in Ascent Multifamily Fund 1. So that you would be a LP for that. And then Ascent would be an LP for all the individual funds. So you don't have to worry about all the K1s and all that, keeping touch with everything. We'll kind of put all the reports, everything in one. And so you can bring all your questions to us and we'll take care of everything.
And that also means there's a layer of legal protection there as well.
Correct. Yeah, so let's see who's Julian. So we were gonna change our fee structure according to how much you invest, but it ended up being pretty complicated logistical wise. So we kind of just made it a flat fee structure and actually lowered our fees. So it's a flat 1% initial fee and then 0.5. And that's industry leading. Other people do 2% upfront and then 1% every year, or they have this other fees. So we decided to keep it very simple and investor focused. BC talks about deducted depreciation against passive income. Totally, yeah, passive and passive. So you can use your passive losses from investing in the fund to offset any passive losses or passive gains you've had, such as capital gains.
And then just the two potential deals we're looking at, they both are one of them is looking for cost segregation, and they'll be able to do a cost seg study. So if you know what that is, that's trying to get accelerated depreciation. And the other one already has a very tax efficient distribution plan, and so they don't think there's going to be much, if any, tax liability from their property. So yeah, we're always really mindful of that as physicians, of how we can bring that down.
Does the fee come out of the 100,000 we invest, or taken out of the returns that they come in? So if you are investing 100,000, 1% gets taken out, and after that, 0.5 every year, and that's it for fees. And then you're getting 10% preferred return from distributions, return of capital, and then at the very end, after all that is taken care of, there's an 80-20 split. Will the former students, so all students, former and current students, get priority? So everyone that has taken the course.
Yeah, so unfortunately, somebody asked if there's if you get in with an initial 100K, I mean, is there potential to add more later? No, unfortunately not.
No.
We're going to be deploying that. The goal is to, I mean, Pranay said 99 people put down 100K, but of course we've gotten some people that have been interested in putting more initially. And again, the goal is to deploy and to use that in the beginning and get into those investments as soon as possible, so that capital is not just sitting around, and get that out there. And so once we kind of make those initial investments, that's it pretty much. And so you'd have to wait for fund two.
So Julian is asking about a catch-up. A catch-up is after you are getting preferred return, a lot of sponsors will say that they're catching up so that they will get 100% of the next returns up to X. And that's a way for them to make money before the actual split. So we're not doing that. So it's preferred return, return of equity, and then 80-20 flat.
Yeah. Again, the goal of this in all our structures here is to be very transparent with it, and then actually just make it super easy to understand from a fee, return structure. And so we welcome these questions.
Yeah, I mean, we're doctors. We try to make things simple. We try to make all the paperwork simple. You know, we want this to be easy to understand. And as you guys know, we're very accessible, and happy to kind of keep the conversation going as well.
So someone asked, like, how does it go? What happens next? So, we've obviously, thanks for being here on this webinar. We're going to be sending this out to people who weren't able to make it live. And what we'll do is sometime very early next week. I mean, obviously, you have the link that if you want to put a soft commit, please let us know that you're interested in that for priority. And very soon next week, we'll be sending out the actual link for people to be able to invest for those kind of in priority. And then we will, whenever it closes. So that'll be there. So the goal is that starting next week, we'll be kind of actually truly opening doors and letting people know. And then once people are in, obviously they'll know what we're ultimately investing in. I mean, it's just like initially on this front side, we have to be obviously careful about what we say or do and where we're going with this. But once you're invested, it's not necessarily blind to you.
Right, and as soon as you've committed, we can share all the underwriting, all the due diligence, and walk through everything. It's just an SEC requirement that we have to be really careful about in the front end, but then afterwards, the deals that we're thinking about investing in, you can see all of them. You can ask us questions about it, and really kind of get to understand what it's all about.
Julian's asking.
And we try to do our best. We're trying our best to give you our criteria for what we're looking for in terms of sponsor. Did we mention that, Myth? We did, right? In terms of some of our sponsor criteria, exactly what we're looking for in terms of transactional volume and years of experience and that sort of thing.
Yeah, definitely. I mean, concretely, we have such a luxury that we have so many great sponsors that we are into contact with. At least we're looking for at least a decade within the industry. And then at least $500 million worth of transactional volume in real estate. And we're fortunate that we have many sponsors who exceed that by multiples. But that's our bare minimum.
Mm-hmm.
I think Julian asked a question.
Yeah, Julian's asking about Fund 2. We don't know. We want to take care of Fund 1. So it'll be sometime in the future, but we want to make sure that Fund 1 is doing well and set before we even consider Fund 2.
I think Scott's asking about first year K1 losses as a percent of investments. I can speak to the deals that we're currently looking at, and these are all very much estimates because, as you can appreciate, the cost segregation analysis hasn't happened yet, and so the sponsor knows from historical numbers what it should be, but until you actually get the engineer out there, you don't actually really know. So it's only around 40%, sometimes a little bit higher, but those are the numbers which we've been quoted. But that's 40%, but you're not going to be earning that much in the first year. So 40% of the investment.
Yeah, Greg wanted to know a little bit more about us. So we will share, here, I'll share this again. So we actually put, I didn't go over it yet, but there's some information about me and us. So we'll share it.
I should say about myself too.
Yeah. So I live in LA as well. I've been working with Peter. I'm an internal medicine doctor, hospitalist. I actually still work full time. Interested in real estate, and Peter and I created the course on Passive Real Estate Academy, teaching about 700 people already about how to invest in real estate. And from that, we've created a ton of relationships and just met with and talked to and vetted a ton of deals and sponsors. So we saw a big need for doctors taking care of doctors and showing each other and supporting each other and creating a platform for us to invest in passive real estate.
Great. Yeah. So my name is Myth. I'm also a hospitalist. I'm currently in Boulder, Colorado. We just moved from Houston. I've been involved in real estate in a couple of different angles. So I actually started off, I was an analyst, one of the underwriters for a large mobile home park right out of residency. And then concurrently, as I'm working as a hospitalist, I'm actually now I own single family rentals. And then I've been working essentially full time with Peter and Pranay getting Ascent off the ground. So I do that full time, and I pick up shifts as much as I can, as well as hospitalist.
Oh yeah, I mean, again, yeah, it's been yeah. If you haven't met Pranay and Myth, I couldn't be excited to work with a better group of people. I think we all kind of have the same vision and mission for this type of stuff, which is that we're looking to really serve physicians when it comes to this whole field. It's not, we've always kind of in our conversations has always been like, what would people want? What do people need? And so if you've been part of, you've seen any of the stuff that I've written and all this stuff. And I think that that's always been a priority for me and for what I've done. It's like, again, it's about, it's about our community and what we can do to help our community. And these guys have had the same kind of mindset. Pranay, he is, in terms of relentless energy, Pranay probably has talked to, I wouldn't even say like, half of the sponsors in America. I mean, it's just the amount of people that he's talked to personally on the phone and gotten to know personally, and the level of detail in which he gets to know. And it's not just the people that are just the investor relations. He spends time with CEOs, CFO. I mean, just the level of, in terms of the relationship, a lot of that has to do with Pranay's diligence on that. And so he's been fantastic for that. And yes, he's the co-founder, the co-creator of Passive Real Estate Academy along with me. And so in terms of doing due diligence and understand that whole world of passive real estate, I would venture to say there aren't many people, like, especially in our world, that know more than Pranay about passive real estate. And with Myth, again, he has this amazing background with, consulting, Accenture there with mobile home park funds and underwriting. Myth he does stuff that I would never want to do. He just has that kind of personality. He just loves numbers. He's a numbers person. They absolutely, when we talk about being data driven, Myth is data driven to the core. And so he's an important part of this team because he is not extremely emotional about these decisions. He is very, very objective about it when it comes to data and understanding that, and his is in the details. And I think that's what he truly adds to this group and this team. And and I'm, my name is Peter, for those who don't know. I started Bloco Passive Income MD, but really personally, I'm just, I've been a heavy investor in passive and private real estate, as well as own a bunch of my own rental properties as well. I've gone heavier into passive real estate over the last, I'd say about 3 to 4 years, mainly because I found it's the best way to leverage my time and capital. And I found that, yes, I can learn how to operate a multifamily myself, and I do enjoy doing it. But I found that there are people who do this in a vertically integrated way with a whole team who've been doing this for 20, 30 years. And so I found in some ways that it's a better way to leverage leverage their experience, their connections, their network, their whole system. And so I've been investing heavily in that realm for, a good 5 to 6 years. And and so that's how this whole thing came about. We had this discussion and we're like, hey, like, how can we make this happen for people? And so that's how we created this group.
It's been a work in progress. We've wanted to do this for years, and it's taken a time to kind of build this up because we had to find the right group of people, the right logistics, the right lawyers, the right accountants, and we want to do this properly, and we want to make this the right investment, because I'm going to be investing in this, and it's going to basically, I want to create the ideal portfolio for all doctors to invest in that are interested in real estate and really don't have the time to, answer phone calls or go find out real estate or do their own due diligence. So this is kind of our goal, and for a while we're super excited to get this off the ground. So let's see. So someone was asking about kind of logistics of how it'll work. So because of the way of the platform, we'll be inviting people in kind of spurts. So you'll have a couple days, we don't want to send you an email and say, hey, you got to decide right now, invest or not. We'll give you a couple days. You can look at the deck, you can look at the paperwork, and then you can invest. You can always invest after that, but every couple of days, we'll be inviting the next group of people. So if we get past 100 investors, which we're already at about 150 last I saw, then we'll have to refund your money or cancel your investment. So that's a lot of work, and we don't want you to have to go through that. So if you're interested, invest when you can, and we'll try to get you in there. Let's see. So someone was asking about arrangements with sponsors. So it kind of varies. So we don't look at the deal and say, hey, 85-15 or 90-10 or 70-30, because that in the end that doesn't necessarily matter. It matters about cash flow, the cash flow that goes into the fund. So we look at it from that 12 to 14% that we're trying to go. And we try to work backwards from that. So we don't necessarily, because we're giving check sizes of, $1 to $5 million, we're able to, like Peter was saying, get a seat at the table and kind of ask for what we want. We don't always get yes, but we're able to ask for what we want and what would make sense for our investors. So it's hard to say because every single fund, the terms are completely different, but that's because we look at it, we look at the deal, and the big thing is risk-adjusted returns. So we look at it from perspective, a lens of risk-adjusted returns, and that 12 to 14% IRR. So the deals myth we're talking about, it's actually closed for outside investments. So one of the big things that you would get if you considered investing in this deal is access to deals that no one can. So from those two deals that we're looking at, you cannot invest in them. And we were able to get allocations because we know them and they know that we take care of our investors and we're good for the money. And kind of what Myth was saying, we've had to say no to a lot of people, even people with 40% IRRs, because they're not transparent with their underwriting. They can do amazing for years, but if we don't know the assumptions they make, we underwrite everything from scratch. And if they're not willing to give us that information, then we have to respectfully say no. It doesn't matter what their track record is, because we have this criteria and we stick to it. Yeah, everyone, it's been great. You know how to ask us any questions. We'll put this recording online and expect an email soon.
Yeah. That's again, the goal is this, we want to, we want to answer any questions that you might have. Just so please be transparent. I mean, the whole goal of this is to be transparent with you and to make sure that you understand what you're getting in. Like due diligence is absolutely important. So I think it's important for you to understand, obviously, some of the basic numbers and metrics. So yes, if you don't understand some terms that we're talking about, please understand them. Try to learn how to what we're talking about. We don't want anyone to go into this, to be honest with you, blind in the sense that they don't know what they're investing in. I think it's important that you do. I think when the reason why the whole accredited investor status was there was the notion that the SEC said that you are basically sophisticated investors and that you know and understand these type of vehicles. And we want people who invest with us to understand these type of vehicles and understand both the gains, the risks, what we're looking at. And so please do your homework. And we're going to do, we've done our best in the past to obviously provide that education for you. But, if you have any further questions, feel free to reach out to us. And in any other case, anybody else? No?
And if we said anything that you don't necessarily understand, let us know. We'll send you some resources. So, we all kind of start somewhere. No one really teaches you commercial real estate in med school. So we all got to start. So there's no problem with starting. Then after you invest, you want to feel comfortable and be able to sleep at night. So we want you to definitely feel that way and provide you kind of the information you need to do that.
All right. Well, thanks for your consideration, everyone. We appreciate you. And thanks for taking your time. Enjoy the rest of your day and your weekend. Okay. All right. Take care. Bye.